Okay, in this interview, we have one of my favorite authors in the whole world, Mr. Jim Rickards, and in honor of his brand new book coming out, The Great New Depression, which I was able to get a sneak read on it. We're going to be discussing that. It officially comes out on January 12th. We'll put the link right there down below for you to go ahead and grab that either in physical or audiobook form. So it's great to see you, Jim.
Great to see you, Jake. Great to be with you.
Okay, so why don't we start here? Where do you think this is all going? You discuss this in your book at great length. Right now, I never would have imagined the government would shut everyone down. We'd have so many people without jobs, so many people behind on their rent and mortgage by many months. And we're in this very bizarre place. Where do you foresee this going?
Well, it's a great question, Jake, and it's actually what the book is about. I just happen to have a copy of it here, The New Great Depression, Winners and Losers in a Post-Pandemic World. You're right, the official publication date is January 12th. So if you pre-ordered it on Amazon or Barnes & Noble, whatever, it should show up in your doorstep on January 12th. What's interesting to me is what I call the rise of audiobooks. About 6-7 years ago, when the Kindles and the ebooks were coming in, they went from 0 to 30% of the market pretty quickly. And everyone's like, okay, that's the end of books. It's going to be, 100% Kindle from now on. That didn't happen. Kindle is still there. It got up to about 30% of the market and plateaued, and it's still about that level. Hardcovers were still selling well, but all of a sudden here comes the audiobook, and of course the difference is you have Bluetooth, so you can take them on planes and cars and whatever. I remember when I used to listen to audiobooks, I'd walk around with a stack. I always get the unabridged version. I'd walk around with a stack of 13 CDs, put them in my car or whatever, but you don't need that now. Obviously you can listen on your iPhone, so they're extremely popular, and I read it myself. I've done that for a couple of books, 3 days in the studio. It's not as easy to look. People just say, well, you're sitting there talking to a microphone. What's the big deal? But I had a voice director who kind of reminded me of Stanley Kubrick. We did one sentence 15 times, no exaggeration, to get it right. So hopefully readers enjoy that. But yeah, this book is the first book that tackles the pandemic and the economic consequences. Now, there'll be lots of doctors and immunologists writing books about the pandemic, et cetera, discussing those policy issues, and economists will eventually get around to writing about the economy. Although economists are funny, they actually, not that many of them write books. A few do, Paul Krugman and Barry Eichengreen, a few others, but they mostly write papers because they're afraid to go out on a limb and things change so quickly. It's like, if things change, well, just write another paper, But if you write a book about economics and you're forecasting, you're really you have to be very disciplined. You're kind of taking a chance, because if you're going to say what's going to happen in 2021, 2022, which I do in the book, and of course that's the consequence of the pandemic, not exclusively, but to a very great extent. You really have to have good models. But I point to my 2019 book, Aftermath, and we did an interview on that about a year and a half ago. But if you turn to page 290 of Aftermath, which came out in 2019, it talks about pandemic, and it says the chance of a pandemic in the next, use the phrase next several years, so make it 3 years, within that time period was 100%. In other words, the chance that it wouldn't happen, the chance that it wouldn't happen was close to zero. And of course it did. But then in the next paragraph, I talked about the consequences, including armed militias and riots in the streets, which we've also seen. So if you read that 2019 book, there's nothing that happened in 2020 that should have come as a surprise, because we talked about pandemic and riots. Now, so the question is, what's in the new book, The New Great Depression, that tells you about 2021, 2022, and that's really the point of the book. So, and I had to wrestle with my editor, my publisher at Penguin. They're great people. We have a great relationship, but she's very bright. She said, Jim, we love you on the economy. We know you can do that. You can forecast, but you're not an immunologist. You're not an epidemiologist. How can you write about the pandemic? And I said two things. I said, first of all, I did go to Johns Hopkins, so I'm not intimidated by natural science. But more to the point, yeah, you're right. I'm not a doctor, and I'm not an immunologist. But I said, it's kind of like writing about property damage in New Orleans in 2005 without mentioning Hurricane Katrina. How can you possibly write a book about the New Great Depression without talking about what caused it, which is the pandemic? So they agreed. during the quarantine, if you're in the fifth grade or the sixth grade, you come back from summer vacation and the teacher says, okay, first assignment, write an essay. What did I do this summer? If you said to me, Jim, what did you do during the quarantine? The answer is I wrote this book. But I read over 100, probably, well, certainly more, but at least 100 peer-reviewed scientific papers in journals like The Lancet, Journal of the American Medical Association, and other top-tier journals to acquaint myself with this. And it wasn't that difficult. Jake, when I started this research, I said, well, okay, this is going to be easy in the following sense. There's going to be a bunch of conspiracy theories and crazy fringe theories and things that aren't credible over here. And there's going to be good scientific peer-reviewed articles over here. And I just have to discard this and focus on this. What happened is when I got into the research, this was easy to throw this away, but when I got into the research, I found that the scientists didn't agree with each other. I can show you peer-reviewed articles that say, if you don't wear a mask, you're a fool, don't dare go outside without a mask, etc. I can show you others, top-tier scientists who say masks don't work. They only make it worse. It's virtue signaling or a comfort level, and fine, if your store requires it, you have to do it. But don't think that they stop the spread of the disease. So what I try to do in the book is balance that out, present both sides, tons of citations. It's got hundreds of endnotes. So, if you read something, you want to go to the source, it's there. So I always say, don't argue with me, argue with the scientists, because I put all that research in the book. But here's the thing. And this is not well understood. This is going to be intergenerational. This is going to affect the economy, not for 30 months, but for 30 years. It's going to be very similar to the Great Depression. That's why I call the book The New Great Depression. I remember I grew up in the 50s and 60s. I did not live through the Depression, but my parents did, and my grandparents did. And the 50s and early 60s, a fairly prosperous time. But I remember, when we were 9 years old, going out with wagons, American Flyer wagons, kind of door to door, collecting tin cans and newspapers. And we weren't doing it for environmental reasons. Maybe it was good for that. But we were recycling paper and tin because there's steel in it, and you could build, jet planes or battleships or whatever. We had a Depression mentality that lasted until the late 1960s. Even though my generation did not live through the Great Depression, it carried on an extra generation. And that's going to be similar today. I have grandchildren. The youngest are actually one on the way, my youngest son, but a couple of my grandchildren are, kind of 3-5 years old. Well, they're wearing masks to school, and that's okay. But imagine you're a 3-year-old and, you wake up and, your mother says, okay, put on your boots, put on your jacket, and put on your mask. And kids are sharp. They pick up on things, and that kind of mask up, pandemic, virus in the air mentality will carry forward. There's plenty of research to back that up, by the way. That's not just an opinion. There's good scientific research. So I think the first thing that we need to know is that the impact is going to last a very long time. It's going to be deflationary / recessionary. That's why I call it the New Great Depression. We're in a depression, and it's going to last for decades.
Yeah, I think, you hit something that I've said a lot in my interviews. I think people do not understand the ramifications of these lockdowns, the amount of people that don't have jobs. It's like earlier in the year, people just thought, we'll close it for everything for a couple weeks and we'll be back to normal shortly thereafter. And
right.
There's just so many people that can't pay their rent and they can't pay their mortgage. And so how do you see this unfolding through this year? What do you think the government is going to be doing? How do you see this playing out for the average person? Because of course, as a human being, it's, it makes me sad and angry seeing what's happened to so many people. But yeah, as a father, you met my daughter before the interview. I'm very concerned, we've already got the dollar index, down below 89. What are they going to do here?
Well, great question, Jake. And here's the thing. The government's going to do a lot and it won't work in terms of the economy. So I can tell you what the government's going to do. We've seen a lot of it already, and we're going to see more. but I can also explain why that won't work. That won't turn things around. So let me just take a step back. Because great question, but it's got 4 or 5 parts there. So let me unpack it a little bit.
Please.
And I said there's research to support the view I expressed earlier. There was a team, a top economist in the research department of the Federal Reserve Bank of San Francisco, and 2 colleagues from the, I believe it was University of California, but it's in the article. You can find the article, and I put it in my book. And they got a 650-year time series. That's my kind of time series. I see people doing correlations and regressions. I say, how far back did you take it? Oh, we went back 1 year or 2 years. I said, no, give me 100 years, give me more, and then I'll give that a little more credence. But they went back 650 years to the Black Death, the plague of the 1350s. And they looked at every pandemic in which 100,000 or more people died in that pandemic over 650 years. And there were 15 of them. And of course, the 2 greatest were the Black Death. They estimate about 75 million people died. And the Spanish flu of 1918, 1919. And they estimates vary, but some credible estimates are as many as 100 million people died. But there are a few others where the number was 2 million, the Great Plague of Seville and a few others. Well, guess what? COVID is going to be in the top 5 and is probably going to end up number 3 after the Black Death and the Spanish flu. We're at about 1.8 million fatalities globally. Looks like that's going to go past 2 million, sadly. And once it goes past 2 million, that's more than the Asian flu of 1958 and some of the other pandemics I mentioned. So this is going to make it's not there now. It's kind of number 5, but it's on its way to number 3 after 2 completely horrific episodes. And what they did, and this was economic research, not medical research, they had the data on the pandemics. They said, how long did it take for interest rates to normalize, economic growth to normalize? In other words, how long did it take to kind of get back to normal? But I'll put normal in quotation marks. We're never getting back to normal. I can tell you that right now. Well, life will go on. We'll get to something new. But it will be a new world in a lot of respects. But just in terms of normalized, maybe is a better word, economic growth, the answer was 40 years. So when I hear Jay Powell say, well, we think we're going to keep interest rates near 0 until 2023, it's like, yeah, Jay, you're right. Try 2043, because that's more like it. But that has huge implications for bonds, gold, and other returns in other asset classes. So that's how people, and that goes back to my earlier point about growing up in the 50s and 60s with a depression mentality, even though I didn't live through the depression, because that's how long these things take to work out. So if you're trying to understand it, think 30 years and you'll be a lot closer to, the right model. Now, specifically, interest rates are going to stay at 0. They'll probably go negative. 10-year yield to maturity on U.S. Treasury notes or 10-year Treasury notes, I expect that to go negative. Now, just to be clear, that's not the same thing as the Fed having a negative policy rate. The Fed sets, a target rate for Fed funds. Right now, it's between 0 and 25 basis points, but call it 0. They could set a negative target rate. I don't expect they will. The reason is that it doesn't work. As I said earlier, they're going to do a lot of things, but they mostly don't work. Europe, the ECB has had negative rates. Japan has had negative rates. Switzerland, Sweden, a few other places have negative rates. They don't work. And the reason is that it's not more of the same. Once you go below 0, you're through the looking glass. In other words, cutting rates from 2% to 0%, that has some impact. You get a bond market rally and maybe there's some more investment. But going from 0 to negative 25 or negative 50 is not more of the same. You don't get any stimulus. What happens is the opposite, because when you go negative, what are you saying? What are you signaling? Well, you're saying that you're worried about deflation, not inflation, but deflation. Well, if people get, and you don't need a PhD in economics to understand this, people just have really good intuitive feel for this. If the central bank is signaling deflation, then what am I going to do? Well, first of all, I'm going to defer purchases. I'm not going to run out and borrow money and spend it. I'm going to save it because prices are going to go down. And also, people say, well, what are negative rates really? It's like taking your money away. You put $100,000 in the bank at 1% interest. You come back a year later, you have $101,000. There's your 1% interest. Well, with negative 1%, You put 100,000 in the bank, you come back a year later, you have 99,000. That's -1. They took 1 point away. Well, the eggheads, the PhDs and all this stuff, they go, well, if I'm taking your money away, you're going to go spend it because you don't want to lose it. No, that's not true. People have lifetime goals. Their retirement, their health care, their children's tuition, parents' health care, buy a house, you name it. Those lifetime goals are the basis for saving and spending decisions. If you have negative rates, people don't spend more, they save more. They're like, hey, I still have my goal, I still have my target, you're taking money away, so I better save more to hit my target. So between the lifetime goals, which induce more savings in a world of negative rates, and the deflation signal in which you defer consumption, people in a world of negative rates, they actually save more and spend less, which is the opposite of what the PhDs would tell you. So my advice, ignore the PhDs, focus on real humans, real people and what they do. But I think the Fed kind of gets that, what I'm explaining. So my point, I don't think they'll go to negative rates, but you can have negative rates anyway in secondary market trading. So there's a huge, biggest bond market in the world in treasury notes, and I use the 10-year treasury note as a benchmark because it's a good substitute for long-term investment, housing decisions, and so forth. Well, how can you get negative rates in that? Well, it's easy. If I have a 10-year note and I'm selling it to you, my 10-year note has a strip of coupons attached. It's going to pay, periodically interest over the 10 years. If you pay me more, if you bid for that note at a price that's higher than the present value of the strip of future income on the interest rate coupon and the principal, if you pay me more than you're going to get back, your yield to maturity is negative. And it doesn't mean you made a bad decision because, A, you could expect that you could sell it to somebody else at a higher premium. I mean, why not? And you may have other factors such as exchange rates. A negative return on a dollar-denominated instrument is not necessarily a negative return if you're a euro-based investor. If you think the dollar is going to go up relative to the euro, you could cash in the interest and principal for more euros. So again, without getting too complicated, I see the yield to maturity on the 10-year note in secondary market trading going negative, even if the Fed holds the line at zero in terms of Fed fund policy rate. What does that mean? It means capital gains for investors in 10-year treasury notes. And all this talk, and you hear from everybody, Bill Gross, Jeff Gundlach, Dan Isaacson at PIMCO. This is the greatest bubble in bond market history. Rates are at an all-time low. They have nowhere to go but up, short the bonds, et cetera. No, nominal rates are near all-time lows. That's true. But real rates are still quite high. And real rates are what govern decisions, investment decisions, borrowing decisions in the economy. So the real rate, of course, is just the nominal rate. That's the rate you see on TV, minus inflation. Well, as inflation goes lower, which it is, what happens to the real rate? It goes up because you're subtracting a smaller number. So the nominal rate has to chase inflation down to try to get to a negative real rate. In 1980, for example, I borrowed money at 13%. It was my first mortgage. My mother cried because I think her first mortgage was like 2%. So I was borrowing money at 13%. But I said, Mom, I'm borrowing at 13%, but inflation was 15%.
Whoa.
So my real rate was -2, and I was paying interest on a mortgage, and taxes at the time were 50%, 50. And it was tax deductible. So the after-tax cost on 13% was actually -8 so I was borrowing money at -8%. I was paying 13%, but with 15% inflation, 50% taxes, and a tax deduction, my real rate was about -8%. That's a low real rate. And that does stimulate investment and so forth, but we're nowhere near that. We might be slightly negative, like 50 basis points or something, but you got to get real rates down to -3 or -4 before you're really going to change behavior. And we're nowhere close to that. So real rates are still high, no matter what the bond market gurus say. The Fed's going to hold the line at zero because negative policy rates don't work. They can print all the money they want. We're not going to get inflation. I know there are a lot of Austrian economists out there like, oh, you're going to have inflation. That's not true. Money printing does not cause inflation. What does cause inflation is velocity. It's the turnover of money. So think of the money supply as like a big pile of dry wood. We're trying to light a fire. We got a big pile of dry wood. That's the money supply. You still need a match. You need something like a lightning bolt, a spark, a match, something to start that fire. And that match, as I call it, that spark, is psychological. I have to feel that inflation is coming. Inflation expectations have to be higher. If I don't spend the money right now or invest in a high yield instrument, I'm going to lose out to inflation, et cetera. None of those things are true. None of those conditions exist right now. Velocity, by the way, that's the turnover. Right? I mean, one example I can give is, I go to a restaurant and I tip the waiter, and my waiter takes a taxi home and tips the taxi driver, and the taxi driver takes the tip money and puts gas in his car. Well, in that example, my dollar has velocity of 3. It was the waiter tip, the taxi tip, and the gasoline, so it had velocity of 3. But if I stay home and watch TV and don't go out, my money has velocity of 0. There's no turnover. And so I remind people, I always say, calculus has its place, but you don't really need integral calculus for this. Just a little 6th grade math does fine. $7 trillion times 0 is 0. Meaning it doesn't matter how much money you have. If you don't have velocity, you don't have an economy. And velocity is psychological. And the Fed doesn't understand it. So they keep printing money expecting, you can get the inflation going and inflation expectations up. And it's not happening. And it won't happen partly because of COVID. And again, this is the connection between the pandemic and the economy.
So then, there's this term that's used a lot right now, and that's this idea of a currency reset or a monetary reset. And, someone like yourself that looks so far out, you said Jay Powell should try 2043. And when you're looking at your models down the line, and then you think about this idea of this reset, are you in the camp where you think there will be a legitimate type of reset where they will eventually institute a new system that's gold backed or whatever it is? Or do you think they're just going to ride this can basically forever?
Right. Well, I'm in the camp that says the people running global monetary policy don't know what they're doing. So I can back that up. So if you say, what's my forecast? My forecast is they're going to try certain things, but what will actually happen will end up being quite different. We'll have a series of shocks and surprises, and you can see this coming as well. So let me be a little more specific about that. By the way, you mentioned the term the Great Reset. That is a great question because if you study, George Orwell or, some pretty, he was a good guy, but there were some pretty evil propagandists out there, and you understand propaganda, it's all about control of the language. It's, the control of the meaning of words. If I can control the meaning of words, then I control what everybody thinks. And sometimes you have to say, wait a second, what does that word really mean, et cetera. And it's funny, the Great Reset, until pretty recently, I think William Middelkoop, I know him, he's from the Netherlands. He had a book, I think it's called The Great Reset, but other people have used the expression. And it was shorthand for a new monetary system, in effect, a new Bretton Woods. We're going to, dethrone the dollar as the leading global reserve currency and replace it with something, and you kind of fill in the blank. Could it be the SDR, special drawing right? That's the IMF world money, maybe. Could it be a gold-backed SDR? Maybe. Could it be a digital gold-backed SDR? Maybe Bitcoin. All these kind of things were in the air, and you could discuss different outcomes. But that was what people meant by the Great Reset. Very recently, in the past 6 months, I just finished reading the new book by Klaus Schwab on this. I should be promoting my own book, not Klaus Schwab's book, but whatever. I got to do my homework. But his book is called COVID-19: The Great Reset. Now, he is the uber globalist. He's the biggest globalist, world government, world taxation you can find. And of course, he's the founder of Davos, which I think they're meeting virtually. Usually it's always in late January. I think they moved it from Davos to Singapore. I've been to Singapore. The skiing's not as good there, but and I think they're going to do a lot of it virtually. So they've been affected by this as well. But he's the big brain and the founder behind Davos, which is basically all the power elite getting together to, and the things that happen at Davos are not the things on the panels and the seminars. It's the private dinners and cocktail parties. That's where all these decisions get made. But his book is called COVID-19: The Great Reset. And he's hijacked the term. I read the book. He doesn't talk about a new global currency, a little bit, kind of in passing, but it's not really what other people mean and what a lot of analysts mean. He's talking about mostly about climate change and that's a whole other story, a whole other interview we could do on that. But what they're doing, their agenda hasn't changed. Their agenda is using climate change. See, if I want a global solution, I need a global problem. And most problems are not global. Taxes, they can be higher or lower, immigration policy, welfare policy, building highways. Those things can go country by country. U.S. can do one thing, Canada can do something else, Germany can do something else, et cetera. But if you're talking about climate doesn't respect any boundaries or borders. And so it's the perfect problem. So if you want a global solution, it's the perfect problem to bring to the fore because in theory, you could only have a global solution to it. Well, climate's changed. I used to live on Long Island Sound. It had a rocky shore. Well, that's because 10,000 years ago, it was a glacier. It was the southernmost glaciation on the planet Earth. So I know it used to be a glacier, but today we can water ski and fish and catch lobsters and go sailing. So climates change. Of course they do. But they change slowly. They change for reasons that are not well understood. The forecasting is very, very difficult. And to suggest that, in 10 years, the planet's going to, be on fire, is nonsense. It's interesting. Go back 20 years or 25 years and look at the strip of 10-year forecasts. The planet's we're going to be dead in 10 years. They said that in 1995, 2000, 2005. They've been wrong every time. They're going to be wrong again. Again, it's not that, but they conflate, pollution with CO2. Everyone hates dirty air. Everyone hates dirty water. Of course, we don't want pollution. Everyone agrees on that. But CO2 is not pollution. It's trace gas. Scientists aren't exactly sure what it does. There's not very much of it around, except that it's plant food. Plants absorb CO2, and then they produce fruits and vegetables and a lot of other things. We could actually have a CO2 shortage. CO2 levels right now are way below what they were 100,000 years ago and even going back further. And there have been kind of many warm periods, the medieval warm period and so forth. So the evidence that CO2 does any harm or that there's too much CO2 doesn't exist. People say it does. You got this guy, Michael Mann at Penn State with this hockey stick chart that's been, widely discredited, et cetera. But they've done a really good job on the propaganda. They got a lot of buy-in, and it suits their agenda, which is we need a global solution. Well, what is the global solution? It doesn't have much to do with climate change. Global taxation, global governance, global decision-making. Oh, interesting. Well, who's in charge of all that? Well, they are. In other words, the Davos crowd. So what I found interesting about the book is they're basically hijacking COVID-19 and using it in the climate change vector to pursue the global agenda that they had all along. But, as Rahm Emanuel said, never let a good crisis go to waste. And they actually say that in the book. Now, the book has a lot of good data. It's a little, my book I think is a lot more interesting, but their book's a little more like a textbook, has a lot of data. So if you want like data on, what's going on, how many businesses, which industries are going to suffer, which industries might do better. We kind of know, Amazon's doing great and the airlines are not. And that's all in my book also, although I would say my book's a lot more interesting. But so that's in there. If you want to reference textbook, that's fine. But reading between the lines and not always between the lines, because sometimes they're explicit, their idea of the Great Reset is the old globalist agenda. So the only reason I started going at length about this, but when you say the Great Reset, you have to specify. You're talking about the William Middlecoop thesis of a currency reset, which is, I've done a lot of work on that, and I talk about that. Or are you talking about Klaus Schwab's Great Reset, which is basically the globalist agenda? So they've hijacked the term. So you gotta, it doesn't have one meaning anymore. You gotta be specific on the currency reset. They don't know what they're doing. The dollar is 60% of global reserves. It's an even higher percentage of global payments. If you're going to replace something, you need something to replace it with. And I spent a lot of time in Washington. My wife hates when I admit that I was once a registered lobbyist, which I was, and I spent a lot of time on Capitol Hill, and I kind of know the game down there. And one of the first things I learned in Washington is you can't beat something with nothing. Meaning, if there's some policy you just hate it, you think it's the worst policy, and you want to get rid of it, fine. But you have to bring something to the table. You have to have a replacement. Washington won't get rid of the old policy unless you can bring a new policy and gather support. It's really an educational function. Well, you want to get rid of the dollar? Fine. What are you going to replace it with? Not the yuan. I mean, in the minimum period of time when the yuan could be a significant portion of global reserve, minimum is 10 years. And I don't expect that. I would say more like 20 years, and if ever. And the reason is they don't have a rule of law. I mean, they don't have anything. They don't have a futures market. They don't have an options market. They don't have primary dealers. They don't have a clearance of payments. They don't have a large enough bond market to even have all those other things. So they're missing like all the ingredients. See, you can't just think about currencies. When people say China has $1.4 trillion in the reserve position, well, they do. But it's not like they have pallets of $100 bills stacked up in the basement of the People's Bank of China. They don't. They invest in treasury bills and treasury notes. In other words, the currency is dollars. That's the numeraire. It's denominated in dollars. But they actually buy instruments. So you can't have a reserve currency unless you have an instrument to invest in. Because again, they're not. This isn't what we call in Philadelphia walking around money. I mean, it's not paper money. Or even digital money. They're instruments. They're bonds. And there's no bond market in the world that's big enough and safe enough to absorb those kinds of investment flows. Even the euro is about 26% of global reserves. The euro and the dollar together are close to 90% of total reserves. That's kind of the whole ballgame. But when you buy notes denominated in euros, you're buying German bunds. I mean, there is no euro bond in the sense of, I'm not talking about dollar denominated instruments, issued in London. That's the old euro bond. When I say euro bond, I mean an instrument denominated in euros, guaranteed by the full faith and credit of the entire eurozone, Germany, France, Netherlands, all put together. That bond does not exist. So when you invest in euros, you're buying German bonds or Italian government bonds. Good luck with those. You can buy some Greek bonds if you want. But the point is, when you segregate by individual countries, those bond markets aren't that big. There's nothing like the U.S. Treasury market. So love it or hate it, there's no substitute. And the reason, it's not going to be the Russian ruble. It's not going to be the Chinese yuan. People say Bitcoin. Okay. I looked at the chart today, but it's clearly a bubble. I mean, you don't need a PhD to see that. Obviously, it's a bubble. It's going to be the new global reserve currency. Really? Well, where are the Bitcoin bonds? They don't exist. You can buy Bitcoin. Yeah, you can go out and buy Bitcoin. It's a digital, ephemeral thing, and that's okay. 21st century, it's all digital. But there's no yield. The dollar price can go up, but watch out for the bubble. Make sure you get out in time. But there is no bond market in Bitcoin, and you can't use Bitcoin. I mean, try buying a cup of coffee with Bitcoin. They always find like one coffee shop in like Brooklyn that will take Bitcoin for a cup of coffee. That's fine, but good. It's probably closed right now if the windows haven't been smashed in. So the point being, there is no bond market, and it's not going to be, because Bitcoin is capped in terms of total issuance. And that was by design. This Satoshi Nakamoto, or I guess his name was, or if it wasn't like an advanced research team from Raytheon, but whoever it was, they capped it out because they hated central bank. You guys print too much money, so we're going to cap it out. Really? Well, when you cap something out, it's inherently deflationary. I mean, because you hit the cap, and we're just about there. There's a little wiggle room, but the cost of mining is now so expensive that we're effectively at the cap, even though there is a little bit more room. When you cap something out and the economy keeps growing, then in theory, each unit of this buys you more of whatever it is you got out there, which is, so when the currency goes up, not the price of the goods and services, but the currency goes up, that's deflationary. That's what deflation is. Well, okay, so now where's your bond market? Do you want to be a borrower in a currency where the value keeps going up? No. Why would you do that?
No.
You got because you got to pay it back in more of whatever you borrow.
Right.
You want to be if you're a borrower, you want inflation. You're rooting for inflation. And one of the points I make in my book is you can make money and you can prosper in every state of the world, including the very dire economic scenario that we talked about. And one example I give is a guy named Hugo Stinnes. He was a German industrialist investor during the worst part of the Weimar hyperinflation in Germany in 1922. So everyone knows the pictures of the guys with wheelbarrows of, Reichsmarks going to buy a loaf of bread, et cetera. Well, what he did, he saw it coming, and he borrowed all the Reichsmarks he could in the early stages, and he went out and bought hard assets. He bought shipping, he bought coal, he bought refineries, all energy or shipping or transportation, hard assets. The inflation, the hyperinflation hits, the Reichsmark basically goes to zero. He paid back all his debts in worthless, I could say pennies on the dollar, but it was like micro millions of pennies on the dollar. But he paid back all his debts in worthless currencies and kept the assets and became the richest man in Germany. And he was known, my German's not good, I don't speak German, but locally he was known as the Inflationskönig, which means inflation king. So he was the richest man in Germany in a world where you had hyperinflation, the currency went to zero.
Interesting.
So you can make money in every state of the world, but you have to see it coming. And that's what the book does. It tells you what's coming next.
So I know you got another interview you got to roll to, but let's go here in conclusion. I think a good segue, right? You're talking about basically hard assets. So Let's talk gold. What's the end game for gold? Where is it going? Is it still important? Are we gonna get to these types of numbers that you've talked about? What do you see with the gold and silver?
Yeah, definitely. Over time, I've raised my intermediate term forecast from $10,000 an ounce to now $15,000 an ounce. And you're like, well, what's up with that? Well, the answer is gold is gold. An ounce of gold is, it's atomic number 79. It doesn't change. It doesn't have any yield. If you stick a gold coin in a drawer and come back a year later, it's still a gold coin. It hasn't multiplied. So a higher dollar price for gold doesn't tell you very much about gold. It tells you much more about the dollar. What it means is that the dollar has depreciated even more. And so with all the money printing, one of the equations I use, and I have a couple different equations, but one of them I use is, okay, if you wanted a gold standard, and I'm not saying we're going to have a gold standard, it might be a good idea, but there's no central bank in the world that wants that because they like having the monopoly over money creation. But if you did, what's the implied non-deflationary price of gold in dollars? In other words, if people say, well, you can't have a gold standard because there's not enough gold to support commerce and turnover and investments in the stock. Maybe there used to be, but there isn't anymore. And that's nonsense. People who say that have no idea what they're talking about. There's always enough gold. It's a question of price. Now, at $1,900 an ounce, no. If you peg gold at $1,900 an ounce, you'd have the worst depression ever because you'd have to reduce the money supply by 80% to maintain that parity. But there's another solution, which is raise the price to, my estimate, $15,000 an ounce. And then that was the same quantity of gold supports any volume of transactions you want if you raise the price enough. And you can do the math and make some assumptions. You want 40% gold backing, 20% gold backing. But historically, 20% was enough. I think today, 40% might be needed because no one trusts the government. But if you just look at the official gold supply, which is about 35,000 metric tons, and the global money supply, which is approaching, using M1, which is approaching $30 trillion with 40% backing. Again, 8th grade math or 6th grade math, depending where you went to school. But the point being, that number is $15,000 an ounce. Now, there are other factors, supply and demand, strategic acquisitions by Russia and China, Turkey and Iran, and others. I just learned the other day that Hezbollah has 500 tons of gold.
Wow.
I would have guessed something like that if I didn't know, but actually there was a hack of their system, and it turns out they have 5, which comes as no surprise because gold is non-digital, non-hackable. You can't seize it or freeze it unless you invade. The point being, it's the perfect asset if you're trying to avoid sanctions or expropriation or freezing, et cetera. That's another, I digress a little bit, that's another reason to own some gold, but it comes as no surprise that anyone who's worried about U.S. sanctions is going to gold because the U.S. hasn't figured out a way to control gold. There is a way to do it. You have to go to the refiners, but talk to Switzerland about that. But no, the short answer, Jake, is gold is going to go much higher, and not tomorrow. It's going to make its way there. It'll get to 2,000, then it'll get to 3,000. One other quick bit of math. Again, it's easy, but a little bit non-intuitive. If gold goes up $1,000 an ounce, it's $1,000 an ounce. You keep the $1,000, or at least your gold is worth that much more. But at progressively higher levels, that $1,000 increment is a smaller and smaller percentage change. So right now, I mean, gold's 1,900, so just call it 2,000 for a round number. If gold goes up $1,000 an ounce from a $2,000 base, that's a 50% increase. But if gold is $14,000 and it goes up $1,000 an ounce to 15, that's a 7% increase. 7% is like a week's worth of volatility. That's not a big move. My point being, it's still $1,000. It's real money, and you get to keep it. But people go, how could it ever get to $15,000? Well, the answer is it's really fast at the end, because whether we're going to have $100 days and $1,000 weeks, sooner than later, because at higher levels, the same dollar amount represents a progressively smaller percentage. So in terms of volatility and feasibility, those gaps, are again just a normal week's worth of volatility. So the point being, this happens, is the famous line from The Sun Also Rises by Ernest Hemingway. The guy says, "How did you go bankrupt?" He said, "Slowly at first and then quickly." And that's how gold is going to get to $15,000, slowly at first and then quickly. But all the more reason to buy it now. And I also have a little bit of I don't know, tease a little bit, but a little surprise for the readers. In the conclusion of the book, it's not a gold book. It talks about gold among other asset categories, but partly in chapter 6 and in the conclusion, I explain how this happened twice in the 20th century under two different presidents, one Democrat and one Republican, and how one guy did it on purpose, the other guy did it by accident, but how it solves all the problems we're faced with. The problems we're faced with right now are debt crisis, deflation, slow growth, et cetera. The solution is inflation. I'm not saying I think inflation is wonderful, but if you suffer too much debt and deflation, you're going to need inflation to get out of it without a collapse. And there were two presidents who figured that out, and I describe it in the book. I don't expect central bankers to agree, but there's your roadmap. And if they pick up the book and read it, they'll understand. But the point I make for readers is that even if the central banks don't do it, you can. You can go on your own personal gold standard and preserve wealth, just like the inflation king in Germany.
Beautiful. So, quick yes or no. So, is it in the interest of the powers that be for the price of gold to continue to move?
It is, but they don't understand it. So I would say, sorry. The answer is it is in their interest, but they don't even know what their own best interests are. But I do explain it in the book.
Awesome. So for everyone, please be sure to head to the link in the description right there down below to get Jim Rickards' new book. And we see it right there, The Great New Depression.
The New Great Depression.
Oh, the New Great, I said it backwards.
The New Great Depression. Thank you, Jake.
Yeah, absolutely. Thanks for your time, Jim.